Okay guys, the next one we're going to have a look at is IS 12, and it deals with income tax. Now, when you're dealing with taxes, you need to remember that there's two types of tax. You've got current tax, and then separately you've got deferred tax. Current tax is simply the tax that's due on the current year's profit. So you've got an organisation that they operate for the year, they make a profit hopefully, and they end up having to produce a tax computation, and the tax computation will calculate how much tax they owe on this year's profit. Now, in fairness, there's very little that they can examine on that. You simply need to know that we potentially will have to pay tax when we make a profit. The only thing that they could throw into an exam question is, when you're looking at your tax liability, assuming that you've got to pay tax, you're going to have to debit something and you're going to have to credit something. The credit will be your tax liability on the statement of financial position. Okay, so you're going to end up with this liability whereby you owe the revenue tax for the profits that you've made. The debit entry is either going to be the P&L or potentially it could be the OCI. Now, the issue here is if the gain or the gains that gives rise to tax have been shown in the P&L, then the tax has to go to the P&L. So if the gains that are causing you to have to pay tax are inside in the profit and loss account, the tax has to go in against those gains. If, however, you end up with a gain that goes to the OCI, well then the tax on that gain goes to the OCI. So effectively what you're doing is you're matching the tax in the same statement where the gain was recorded. That's current tax. Second one we have is deferred tax. Deferred tax is the future tax effect of current year transactions. Okay, now I just need to explain what this means so that you can identify it if it does happen to come up in the exam itself. If you have a transaction that you recognise in this year's accounts, and if that transaction is going to have an impact on the taxes that you're going to be paying in future, then you're dealing with deferred tax, simply because the tax effect is deferred until a future period.
Okay, question 44, page 120. Now, this is a typical 20-mark question, and there is a good chance, actually, sorry, it's 25 marks, they've taken it over from an old question, okay? But there's a good chance, that if this was, it would just maybe be one adjustment less to make it a 20-mark question. But there's a good chance that consolidation would be a 20-mark question on the exam. Sorry, if it's not, they will just be taking a number of these, like NCI maybe or goodwill, and be asking you to go away and work it out. Okay. So what we have in this question, now, we know that when we're dealing with consolidation, we have a couple of steps that we want to follow. And the first thing we wanted always to get was the group structure. And no matter what kind of a question you have, you should always get the group structure out of the way first and foremost. All right. What you'll have is you'll have a holding company and a subsidiary. You might also have an associate, as we have in this question. And okay, so you've got the holding company and the sub. What's the first thing you want to establish about the holding company? First thing we want to establish is the shareholding. And if you're just taking this question here, I suppose, how much of this company did we acquire? What information are we given? We're told that a majority equity shareholding on that, an immediate payment of that. Okay, they don't tell you how much. Okay, when you look at the investment, they tell you that we acquired 8 million shares at $4 each. All right, so somewhere on the exam, sorry about that. Anyway, somewhere on the exam, they have to give you an indication as to what the investment was. How many shares are in Saracen? How many shares does Saracen have? They have 10,000. What do you have to throw a courtesy eye to? The nominal value. Make sure that they're $1 each. Because if they're 50-cent shares, well then they would have 20,000 shares. Okay? So now in a lot of questions, they've told us that we have an 80% shareholding, or they tell you at the start that you bought 8 million shares or whatever. But it has to be somewhere on the question, because you have to know what the investment is.
So let's just make kind of a couple of things here about technical articles, particularly about one that we haven't had a chance to practice. Okay, so stakeholder theory, which is the big one. All right. There's one in particular. Okay, so there's an essential technical article, and you really cannot afford to go into the exam not having read this, even though it's one of the earliest ones. Okay? And the crucial thing with this, you've obviously got, for example, it has, you know, some of the definitions in the beginning. Okay, like, you know, claim. All right, what exactly, a stakeholder is, should I say, first bloody thing. What's a stakeholder? Any person, place, or thing that affects the organisation, can be affected by the organisation. All right, so you've got your stakeholder. It's got like what a stakeholder claim is. It's also got this whole idea of watch out for stakeholders because there's this thing called bidirectional influence. Okay, so, you know, another idiom, you know, that could come back to haunt you. That could come back to bite you on the backside. So be careful how you treat that stakeholder because that could come back to haunt you subsequently. Then we have the Menlo matrix, which we've covered now. So you can scan through that very, very quickly. It's drawn a little bit sillily, if you ask me. Sillily isn't the real word, is it? It's kind of like Donald Trump and bigly. Okay, it's drawn a little bit inappropriately. Okay, and then we basically have, all right, the 8 pairs of stakeholders. All right, and this is crucial now. All right, that you kind of make sure you have this technical knowledge. All right. So, we've covered a lot of that. I think we're quite happy with what a stakeholder is, what a stakeholder claim is, their demand, their expectation, their desire. You know, and it mightn't be a valid claim. It might be an outrageous claim. I'm trying to remember, who was it that was looking for a 52% pay rise there last year, initially? Was it the Lewis drivers? Yeah, wasn't it? Like, you know, that was their pay claim. And you kind of go, what the hell? You know, so again, you know, just because it's somebody's claim doesn't mean it's kind of, you know, a claim to be taken seriously or to kind of, you know, be viewed on, or, you know, and so forth. Anyway, you get the idea.
So Chapter 31 is very easy. It's just a corporation tax startup exemption. Just while you're finding that page, good evening to those of you online. I assume you heard I'm not Michael, in case you thought there was something wrong with your screen. Okay, so CT exemption for startup companies. Michael covered corporation tax with you last week. So this exemption is relevant for new companies who have commenced a brand new trade, and it has to be a qualifying trade. So sometimes trying to remember what this relief is about, it helps to understand why it was introduced. Okay, so you remember back in around about 2008, the country was in recession, and what revenue needed to do was to stimulate the economy. Okay, to stimulate the economy, they needed people to invest, to start up companies, to start employing people, carrying on trading activity and so on. So what better way to do it than to give an exemption for brand new companies from corporation tax. Okay, so if the company commenced trading after 1st of January 2009, so that's when it was first introduced. Okay, so think of 2008, the country was on its knees, and from 1st of January 2009 they said, right, let's introduce this exemption. Okay, and it wasn't going to be something that was available for existing companies, so it had to be a brand new company incorporated on or after 1st of January 2009. So we've got case 1 income is 300,000. Case 5 income is 80,000. That's total income of 380,000. CT at 12.5%. is 37,500, and CT at 25%. So the 80,000 is taxable at 25%. That's 20,000. Total CT liability is 57,500. In order to qualify for the startup exemption, the total CT liability must have been less than 40,000, not just the CT on the case 1. Okay.
All right, just before we sort of start, just required by ACCA, just to go over the exam format. Okay, I'm sure most of you are familiar with it. Okay, is anybody doing the computer-based exam? Nobody at all doing it? No. They're trying their damnedest to get people to do it. I mentioned there's a couple of people online actually doing it. But the exam is now split into sort of 3 sections, sections A, B, and C. Okay, section A is 15 2-mark MCQs. Okay, giving you your 30 marks. So on anything, random ones, cover the whole syllabus. Okay, so all of it will actually be covered. Okay, section B. Okay, you've got 3 10-mark questions that are made up of 5 MCQs.
Okay, they're almost like sort of mini, sort of longer questions. You'll have sort of 5, 6, 10 lines of data and a few figures, and then you'll have 5 MCQs that relate back to it. Okay, all right. Now it doesn't mean that it's only on one topic. It can have 2, maybe even 3 topics in it. Okay. Now what's the ones we've seen? What it tends to be is 2 or 3 out of the 5 MCQs. Okay, are sort of calculation-y kind of ones, and then the other 2 of them, or maybe 3 of them, will be more sort of discussion theory ones. Okay, so between the 2 of them, they cover a huge amount of the syllabus. Okay, pretty much all of it. And then what you've got is you've got two 20-mark questions. Okay, for the last 40 marks, give you your 100 marks. Okay, now the section C are the only ones that are human marked, or as they say, referred to as expert correctors. Mark them. Expert correctors mark them. Okay, so these are all, A, B, C, D, right, wrong. You get them right, you get the 2 marks. You get them wrong, you get nothing. Okay, it's nothing for workings or anything like that. You just have a little sort of bubble thing you fill in with all the actual answers to it. This is the one where they're actually sort of human marked. Okay, so when you're going to do the exam, you'll have sort of your answer book that you write in, and then one that has put the MCQ answers actually on it. Okay, now 100% compulsory. You have no choice on it. You got to do them all. Okay, you have 3 hours 15 minutes on the paper-based one to actually do it. So just over 200 minutes. You have 100 marks, so approximately 2 minutes a mark. Okay, it's approximately what you have.
Okay, so the first one then, Sinead, how would you alter the company's name? Special, good. How would you convert from a private company to public company status, Jack? A written. Well, think about how big a deal that would be. Private to public. Special, yeah. Convert from a public company to a private company, Shauna. Yes, special. They're all a big deal. Change the address of the registered office. This is slightly different. Dylan, did you get this?
I guessed ordinary.
Okay, it's actually a resolution of the board. Convert even from limited liability to unlimited liability. Okay, now, is that a big deal? Yes. Okay. What do you think then? Special. And it's actually even a bigger deal. It requires unanimous consent. Do you remember when we did it? Of the members.
Retained earnings, as I mentioned a couple of times, has become fairly fashionable during the whole area of the recession, is to kind of say, right, let's hang on to what money we made and put it back into the business. And that's retained earnings. In other words, we'll grow our business through our own self-financing. A lot of retail companies would do that. The likes of Don's and the likes of Apple have so much cash when they came during the week. They have so much cash available. So in other words, they won't have to go to a bank or an outside to grow the business. They'll use their own cash, whether they'll buy up a smaller business or whatever they use it for. But they have the cash there ready to go. And again, with the property, there was a lot of property companies during the downturn. They had a load of retained earnings. They'd stockpile their cash, and then they were ready to go and buy whenever they have to.
You will definitely be using the formula sheet. Let me draw your attention to the formula sheet, okay? And we are actually going to be referring quite a lot to the formula sheet throughout revision. Now, you will be given just simply 1 page of formula. And there is quite a lot of formula required at various different points during the F2 syllabus. So what I will be doing is any formula we come across that's not on the formula sheet, we will take note of that formula because it will probably be required on the day of your exam.
So section 1 is financial reporting and the theory of the context and purpose of it. Okay. Some of these questions are so obvious. Just eliminate the obvious ones. They're very straightforward, but we'll work through them all. Who issues the IFRSs? Is it the advisory committee? Is it the stock exchange, the International Accounting Standards Board, or the government? A, B, C, or D? And the answer there would be C. Certainly not the stock exchange, certainly not the government. The advisory committee, their role is just to take soundings from the profession. And they go then to the advisory council. They instruct the IASB to issue a standard. Now, before you get a standard, you get what's called an ED, an exposure draft. It's kind of like a trial version of the standard. Once that's being kind of sent out and tested and tried,